When I spoke about this topic several weeks ago, I noted that one of the tells for the stock market would be whether high yield bonds continue to participate alongside equities. And for the most part, that had been true. While new highs did not exactly coincide with each other, basically upward moves in the stock market were largely confirmed by upward moves in the high yield ETFs and vice versa. And when I speak about high yield ETFs, the two go-tos are HYG and JNK. They're essentially interchangeable. They correlate, when I last looked, about 95% or higher. So we could just use the terms interchangeably. But what I've noticed in the past few weeks, as the stock market has launched itself to new highs pretty much in a straight line since mid-October, the high yield ETFs have not followed along. They've kind of puttered along in a sideways, actually some slightly down fashion. Not enough to call it a downtrend or a top in those ETFs, but it is interesting to see stocks rallying without being accompanied by high yield ETFs. And why do I look at that and see a possible warning sign for stock markets? Basically, go back to the corporate structure of a company. Equities are at the lowest rung. Basically, equities only get paid after all the bondholders recover what they can, which is why equities often go to zero in a bankruptcy situation. There's preferred stocks, which we'll kind of ignore in this situation, and then above that is corporate debt. The corporate debt market is heavily dependent on your credit rating, and high yield debt is at the low end of the credit scale. So as a result, in the corporate structure environment, high yield bonds basically rest just above equities in terms of risk. Now the dynamics are very different. You don't get the upside in high yield bonds in many cases because realistically you're just hoping to get paid back at par and collect your interest. So there isn't necessarily the capital appreciation unless you're buying the bonds at a discount, and even then it's relatively capped. But you also actually have a little bit less downside because unless the company is so heavily indebted, there's often recovery to the bondholders. It's just a matter because of their low rating that they tend to trade with higher yields, and there's a greater likelihood of default attached to them. So also, as companies retire stocks, whether they do it through LBOs or leverage buyouts or private equity firms buying them, or companies issuing stock to pay them to either pay dividends or buy back shares, which is a phenomenon we've seen over the last few years that have helped to drive the stock market. If there's reduced demand for corporate bonds, and again, the tell in corporate bonds would be the lowest rated corporate bonds, i.e. junk. If there's not an increased demand for that, that's something to be concerned about. That doesn't mean to say that you should sell stocks because the high yield market is underperforming. You might actually argue that that's time for a pairs trade where one has rallied and the other has sank. That's if you believe that the correlation is going to return, that's when you do that sort of trade. But I'm just looking at this as a bellwether for stocks and a bit concerned that when you see what should be a leading indicator, the high yield debt market, starting to putter out as stocks move higher, I would put that on my radar of things to concern yourselves with. Not necessarily a reason to sell, not necessarily a reason to even change your positioning, but something out there that says, all right, the situation looks so rosy in equities. What might be out there on the horizon? That might be one of those things.